One of the most frustrating things as a trader is to watch the market open and push strongly in one direction, and you're sitting there waiting for a good pullback or a retest and it doesn't happen. In this video, I'll be showing you how to catch strong moves using one easy candle so that you can take high probability trades within the first hour of market open and enjoy the rest of your day. Why should you care about this strategy? You should care because the market does not move straight up or straight down. When you're sitting there feeling like, oh my God, it's moving down. I can't, and I've missed where I was watching to take the trade. The market would give you an opportunity if you're prepared for it. So in this video, I'll be covering the one candle strategy, the conditions for the strategy, why this candle works, the pros and cons, and I'll be showing you how to get your entry, stop loss, and profit target, and useful tips. So what are the conditions for this strategy? Number one is that there has to be a clear trend. Think of T as trend, clear trend. So higher lows and higher highs in an uptrend, and in a downtrend, lower lows, lower highs. What you do not want to see is sharp. Absolutely not. Don't want to trade this strategy when we are just consolidating within a very tight range. And number two is probably the most important because it increases your chances of winning by a mile anytime you're playing direction. For uptrends, you want price to be above the opening print if you're trading to the upside for bullish setups for buys. And for sells, you want price to be below the opening print. That increases the probability of this trade working out. So now that you know the conditions, let's talk about the rationale for this strategy. When we have strong moves in one direction, price will most likely retrace. If you don't know what retrace means, pull back to fill orders before continuing in the direction of the trend. These are key areas where institutions have placed their orders and they would come back to fill those orders before continuing back up. And this one candle is also referred to as order blocks. There are multiple names for it in the industry. Some people call it one candle, there's buy blocks, sell blocks, order blocks. There's so many names. So how do you identify them? In an uptrend, you want to look for down close candles, also known as the red candles. To mark out your most recent down close candle from the top of the wick to the body of the candle or the open of the candle in this instance. And in a downtrend, you want to look for up close candles, also known as the green candles. It's not that simple as, okay, just mark out top of the wick to the body of the candle. There are different candle formations, and based on the candle formation, you can identify which ones are higher probability and which ones are the least likely to happen, and I'll be going over that. So down close candles, there are two types of candles I prefer, and number one is where you have a longer wick in the direction of the trend. So in an uptrend, you have this longer wick and you have a body. In this case, you would mark the top of the wick down to the open of the body of the candle. That's the best case scenario. The rationale behind this is that rejection or absorption of liquidity makes these order blocks higher probability. This rejection makes it higher probability that yes, once liquidity has been absorbed, buyers have pushed price higher, right? Buyers have succeeded in pushing price higher, and when it comes back to retest, the strongest ones don't even go into the area. They just tap the top of the wick, and you see buyers start to step up on the following candle. So the second best one now is where you don't have much of a wick, but you have a small wick. In that case, you just mark the top of the wick to the close of that candle. So you're just getting the body as well, part of the body. And you're waiting for buyers to step in and confirm that the move will continue. That's the second best candle scenario. The least probable candle, you guessed it, is when there's no wick. And in this case, it's low probability. The chances of it happening is much lower than when you see this two candle scenarios. So other blocks without wicks are just candles that moved in one direction. Now for up close candles. You want to look for up close candles when the trend is down. And like I said, you want longer wicks in the direction of the trend. This is how you remember it. That's your best case scenario. And you mark from the bottom of the wick to the open of the candle. And number two, where you have a tiny wick, but there's a wick present, you just mark bottom of that wick all the way to the top, the close of the candle, to where the candle closed. That's the second best scenario. Remember, if you have wicks, it just increases the odds of the order block being respected. If you don't have wicks like this one, you have to draw the full body the candle, it's now lower odds. It's lower probability and it just might not work out. Now I'm going to go over the pros and the cons of using order blocks to catch strong trending moves. First, we'll go over the pros. Number one, it helps you trade with the institutions and not against them. You want to go in the direction of the institutions. Those are the people that move the market. You don't want to be on the other side of the institutions. Order blocks work on multiple time frames. You can use it on the time frame you are trading. Last but not the least for the pros is strong. It is strong when combined with liquidity concepts. So when you have multiple confluences or things coming together to make the trade even more high probability, maybe when it's in line with your 5-minute opening range high, or it's also in line with your previous day's high or low, or it's in line with your higher time frame key levels, it's high probability and you should take those trades. Now for the cons, not every order block holds, and I'm sure I've gone over why that is the reason. You have order block formations that are high probability and some of them are low probability and some of them might fail. It requires additional confluence to filter out the good versus bad trades. So with time and experience, you'll be able to then know which one works and which one does not work. And last but not the least for the cons is it's difficult to execute without practice. You can't just watch this video and all of a sudden done. I encourage you to back test it, open your charts and you don't even have to run a sim right now. Just open your charts and try to find those candles and see how you can trade them. That's my challenge for you. Now, as for entries, stop loss, and profit target, let's look at this chart. And I want you to do the same thing. Go and do a similar exercise and markup chart. So this name, QQQ, opened very weak, right? You see that price was rejecting at open and we saw a strong move to the downside and we broke the 5-minute opening range low. When we broke the 5-minute opening range low, we had this ugly looking up close candle. Based on what I said, look at the wicks, right? Draw from the bottom of the wick to the open of the candle, and that's your order block here. Now you just need to see what happens. Price continues lower, forms a low of the day, then we see another pullback with up close candles, and now you're like, okay, I can enter this trade, and your risk in this case, usually you should be risking the top of this order block, but you can see that we had a bunch of wicks here, red candles wicking, and based on market structure, this is your lower high, so that would be your stop loss. A break above this candle will be your stop loss, and then you can target low of day as your profit target. And in this case, this was a 1 to 2 risk to reward. See how I've used one market structure, I've used a key level, which is your like 5-minute opening range low, I've used order blocks to enter this trade. So you need to be able to understand how price moves. Oh, the trend is strong to the downside. We're selling strongly. This order block is high probability. It came into it and we pushed lower and we even sold lower. And the thing is, you might not even need to use order blocks to enter a trade or as a reason to enter a trade. You can use it as a reason to stay in the trade and trail your stop loss. That's another way to use it. It's a powerful way to use it after you've taken your initial profits and you maybe have more shares or you have more option contracts. You can continue to ride the trend as long as it respects the order block. Now, I'm not going to end this video without giving you useful tips. Number one, it is best to trade order blocks on higher time frames. Obviously, like another block on the 1-minute time frame would have less significance than order block on the 15-minute time frame or another block on the 1-hour time frame. So the significance of order block increases with the time frames. You can use order blocks as trailing stop losses. If price respect the order block, stay in the trade. Do not chase moves and enter order blocks when the higher time frame objective has been met. So you want to be mindful when you use this, because if the objective was for the name you're trading to move towards, say, a 1 hour key level, and it has already hit that resistance or supply, the move is most likely done. It was probably pause for a bit and chop around and all of that. You want to take the trade when early enough that you are not then buying or selling at the top or bottom. You have to know your higher time frames and know where the next liquidity level is for you to be able to trade these successfully. The best trades happen around key levels, around the higher time frame support or resistance, or you're using the previous day's highs or previous day's lows, or opening range high or opening range low, like the example I've just shown. I hope you're able to get some value from this video. I'll continue to build on this concept in future videos. Thank you so much for watching, and I'll see you on the next one.